Hello, and welcome to the University of Nebraska-Lincoln Center for Agricultural Profitability webinar series. I'm Brad Lubben. I'm an Extension Policy Specialist here with CAP, and I'm pleased to help host and present today's webinar focused on the Nebraska farm income situation and outlook. This webinar today is part of our weekly webinar series that's really been ongoing for nearly 3 years. You can find us every Thursday at noon right here on cap.unl.edu. The schedule of upcoming webinars is available, as well as always an archive of our previous recordings in this series. Today's focus webinar is, as I said, focused on the Nebraska farm income situation and outlook. We have numbers that we'll talk about that relate Nebraska farm income and U.S. farm income, and they really have taken a mirrored path through the last 2 years. Both set record levels in 2021, only to see U.S. farm income jump up substantially in 22 before falling back in 23, whereas Nebraska farm income fell in 2022 and has recovered at least somewhat here in 2023. We're going to take a closer look at that and dive into the causes and the drivers and perhaps give some perspective about the road ahead. We're going to utilize information from USDA's Economic Research Service and some of our historical data, as well as projections put forward by the University of Missouri's Food and Agricultural Policy Research Institute and the Rural and Farm Finance Policy Analysis Center, or RaFF. It is, in fact, the collaboration between CAP and RaFF that is the feature today, and I'm pleased to welcome Scott Brown to share the podium or share the Zoom presentation with me today. Scott's the interim director of the Rural and Farm Finance Policy Analysis Center, or as I noted, RaFF for the acronym. Scott's also an associate extension professor in ag and applied economics at the University of Missouri down in Columbia. So Scott, it's a pleasure to have you join us today. You're providing a broader outlook at the economy and the national farm income outlook, because as I noted, that really sets the stage for comparing how Nebraska has fared over the last couple of years and the path ahead. So I'm going to stop sharing my slide there, Scott, and turn it to you and invite you to present and share the national discussion. For the audience, I'll note as I turn it over here that you're able to view and listen to all this. If you have questions throughout, please communicate them via the chat box or preferably via the Q&A box in Zoom. We will hopefully have time and respond to all the questions that we can, but please share them as you have them and we'll get to them in time. Thank you. And Scott, I turn it over to you.
Thanks very much, Brad. It's good to be working in collaboration with CAP on farm income at the state level. It certainly is an opportunity to look at how farm income changes as we move around the country. I think we're all learning that not every state moves in lockstep. Commodity mix, weather, or just a couple of the factors that I think are at play. As I speak today, I just want to remind everyone again that the FAPRI group recently updated their long-term baseline, and that's really the foundation that we're using today. I get the opportunity to wear both the RaFF hat and still some of the FAPRI hat, and it's a unique opportunity to talk about taking projections of commodity markets at the national and international levels that FAPRI does and begin to drill down what's it mean for individual states. So I want to give the FAPRI team credit for the work they're doing that we get to build on. And I start right away with this notion of what's been happening in U.S. farm income. And a couple of things I always like to say when I look at net farm income, the gold line here that I have on the graph for you this afternoon, from where we started in 2020 until where we peaked in 2022, that was a phenomenal increase in net farm income. A lot of things at play in that strong demand. I think weather's had impact, but getting to $180 billion, I've been doing this for a while, and I don't think I would have ever guessed that we would have been talking about U.S. farm income at $180+ billion ever, and we've gotten there now. I always say it's not surprising. It's hard to hold those kind of record levels of farm income. So it's not surprising when you look at where we're sitting for 2023, that $145 billion or so in net farm income, and then the projection that FAPRI has for 2024 would suggest another slide lower in terms of farm income. So again, hard to hold those levels. I would just point out how large 2022 was to where we were before. And as folks want to think about that history a little bit, 2015 to 2019, when we had $75 billion in net farm income, what a difference a few years has made. And so it's hard to, I think, step off of what's been this record level of farm income and know what's the best strategy as we move forward. I use this slide just to remind us that I keep saying I think we see kind of a cost price squeeze coming in front of us, and that when you look at 2023 cash receipts, they're going to be about $21 billion lower than where we were in the peak of 2022, yet production expenses about $30 billion higher. If I talked about the risk I see as we move forward, is that we continue to see that squeeze. Now, we are seeing some inputs that are lower, but it seems like it's always easier for the receipt side to move lower than it is to get costs to move lower. And we know things like interest rates are staying high. And that's going to add to the production expense side of this equation. We don't have a new farm bill written yet, so government payments continue 2018 farm bill in front of us. It just reminds me that we may have a lot more discussion about safety net and what we need in the next farm bill if we continue to see some erosion in overall farm income levels. Just to bring in a little different flavor, something that we've been working on with Farm Journal here at the University of Missouri the last few months is a survey of the major ag economists around the country that are focused on ag markets specifically. I just want to point out, so this survey is, as you see on the lines on this graph, where do we see things relative to last year, relative to last month, and then next year. And when you look at the September survey results, it just says our group of ag economists has become a little more negative. Now, I want to be careful about being too negative in this discussion, because you notice we're still on the graph between unchanged and slightly worse off. But that momentum seems to be carrying forward, as at least some commodities have I think struggled in 2023 from a profitability standpoint. We'll talk about those in a minute. I like to index all of these commodity prices, and I think we have a lot of them that are important to Nebraska setting on this slide as well. And I sometimes go at it this way. Somebody tell me, so number one, the index of 1 in 2000. So that's where all these prices started in 2000. Corn more than 3.5 times where it was at its peak. There's been a lot of volatility. I think you can look at any of those lines and say there's a lot of volatility. This does have the projections that FAPRI has from the August update incorporated. You might notice those lines are relatively flat in front of us. I wouldn't want that to give you the idea that we think volatility might be over in front of us. It's just baseline assumptions, I think, drive that. So no weather events in front of us, no major economic downturns from the macro data in front of us. I expect there's a lot of volatility still ahead in these markets. And just, again, stepping off of all that volatility, doing market outlook back in the 1990s was a lot easier than doing market outlook today. And I think this graph certainly reminds us of just that volatility. When you start looking at some of the individual results that FAPRI has, number one, lower crop prices ahead. We look at soybeans that for the crop that we're harvesting this fall, an annual average of 1288, continue to move lower the next couple of years. We do see some strength, longer term, and I think that's really renewable diesel driving a lot of that strength that we see on the soybean side. I look at corn, the green line on this chart. We were 660 in terms of what we harvested a year ago. 494 today. FAPRI says below 450 for the crop that we harvest next fall, and we kind of stay in that 430 to 450 range thereafter. That's a lot different than what we've seen, and I think that these peaks that we see in the 22-23 prices correlate very nicely with what was record farm income. So more worry ahead, but yet those prices are above longer term averages. You could even go back to 18-19, and soybeans and corn price projections that FAPRI has are above year ago levels. It's a little bit the opposite on the livestock side of the equation, especially cattle. We're talking about cattle prices that have been at record levels for points in time during 2023. I think when we look ahead in 2024, we're going to continue to find record cattle prices occurring. Taking a little step back here the last week or 2 weeks, but I think we still have some pretty optimistic opportunities in front of us. And it takes a while for us to build the cow herd back to a level that we might talk about those prices moving lower longer term in that baseline. Hogs, on the other hand, it's been a tough year in 2023 for hog prices. We really don't show a lot of recovery from the prices that we see in 2023 on the hog side of the equation. I would remind you, perhaps from a hog perspective, the thing producers are going to be most happy about is if feed costs continue to move lower like we project corn prices will do, that may help with the profitability side of the hog market. Likewise, back to our survey for a minute. So ranking from best to worst, I think this starts to kind of lay the foundation for how different states fare in terms of farm income relative to the commodity mix they have. Our survey of ag economists put beef cattle at the top of the list, and at the other end, you end up with hogs and dairy at the bottom end, soybeans, sorghum, corn setting up there as well. It, again, gives you a flavor of what we're seeing in terms of the financial performance of these different sectors that again lay the groundwork. On the cost side, we have seen prices paid for some of these ag inputs move down from the records that we would have seen back in 2022. You'll notice a few of these do have a hook at the end here in terms of the current data that we have. Fuel prices being higher again. We'll wait and see what that means as we get to 2024. But when you look at the general projections from a production cost side, FAPRI has what's essentially a decline in all PPI production items in 2024 and no real growth in front of us. So when you look at the baseline, that would suggest to me no continued increases in production expenses. I would remind us these are percentage changes. So we're not talking about a PPI that's back to where it was a pre-COVID period, if you will, but we're talking about a PPI that levels off and declines slightly in 2024 and 2025 in particular. So projections suggest we'll be better on the cost side. As we look at a little bit of what drove the crop outlook side, I just always like to start to remind us that we've had weather problems in some parts of the country that have kept us below trend yields for all of these commodities the last couple of years. We think about what happens in the crop we plant next spring. If we had trend yields, which all can decide what you think trend is for these different commodities, I think that puts more corn and soybeans in the bin in the fall of 2024, and could be one of the drags, if you will, in terms of lower prices ahead. So yields are going to be important to that mix. If we look at corn for a minute, I always say if you want higher prices, we need to grow demand categories of some sort. And you look at ethanol, feed, exports, all of them have been fairly flat for a number of years now. And it's hard to see kind of that next demand driver on the corn front. I always say I think all three of the demand lines on this chart could grow a little bit in front of us, but I don't see any of them growing in leaps and bounds in front of us, given current markets. And I think you would find that out of the FAPRI projections with this August update. A different story in terms of soybeans. We see continued increases in soybean crush as we're seeing soybean oil continue to stay high. Again, I think renewable diesel certainly helps us on that front. We have seen exports that have moved down the last couple of years. Demand from South America, supplies from South America certainly can weigh in on where we see exports out of the United States, as Brazil in particular continues to gain some markets that traditionally might have taken some product from us. I will say we have to continue to be paying attention to what's happening outside the United States as crop production continues to grow. And it's primarily what's happening in South America, but we're getting growth around the world. And yes, we have Ukraine, Russia that weighs in on this discussion in terms of the conflict. That leaves us with some uncertainty. We'll have to watch that as we look ahead. But again, growth in South America, I think, has certainly been important to this outlook. On the livestock side, I'm just going to spend a little bit of time talking about the cattle and hog side for this webinar, just to keep us somewhat on pace. I always say the supply side here is very clear. We have fewer beef cows. I think we're going to continue to have fewer beef cows. And perhaps for a longer period of time, when you look at the baseline projections, even January 1 of 2025, we show slightly lower beef cows at this point in time. We were down 2.6% July 1 of 2023, so this last summer, relative to a year ago. So I think that probably continues in front of us. I will say we're getting more productive on the cattle side as well. So even though we have fewer beef cows today than where we were back in 2014, we're producing more beef today. And I think it's important to remind ourselves that productivity matters in overall beef supplies. It doesn't take much to remind us that dry weather has really affected cattle inventories. I look at focus here on Nebraska for a minute. So these are the top 10 beef cow states. About 60% of beef cows in these 10 states, from Texas to Arkansas. Nebraska sits there at number 4. But when I look at the green and black bars here, so 2022 and 2023, I know there's been a lot of dry weather in Nebraska. Certainly been tough on cattle inventories in Nebraska. You can say Texas, Oklahoma, Missouri, Kansas, all have been facing tough weather. It hasn't really, so we're not done with drought, by the way, it doesn't appear. And in fact, when you look at the latest data, it would suggest we're actually getting drier again in some parts of the country. So I think that has a lot to do with what's slowing any kind of interest in regrowing the beef cow herd, as some don't want to feed very expensive hay, and some want to see some recovery in both hay and pasture before really making that leap to grow beef cow inventory. I always say from a beef perspective, this is the graph that matters at the end of the day. When you look at what USDA is projecting in terms of beef production changes, so a 6.6% decline in 2024. down in 2023 for the first time since 2015 in terms of beef production. I sometimes like to remind us of when have we done that. So in 2014 was the last time we did it. Fed cattle prices were 25% higher. Before that, it was 2004. We didn't get a lot of lift in cattle prices that year because we did have BSE show up in late 2023. And before that, you have to go back to I believe it's 1980, the last time we saw that kind of decline in beef production. And we really haven't seen a back-to-back like we're going to see in 2023 and 2024, which just reminds me, I think we can talk about even higher cattle prices as we look ahead. It's interesting. Consumers continue to seem to have strong demand for beef. I always say, if you ask an audience if they want to have a really good meal, what do they put on the plate? And many of them will say steak. And I think the cattle industry has done a wonderful job. There could be some trade-offs when you see where pork chop prices are today, for example. Beef prices, steak prices in particular, are certainly much higher. Do we get some trade-offs there? I've often said I think substitution between these meats are a lot less than would have been the case several years ago. But we're going to have to continue to talk about how consumer demand looks. When you look at pork in particular, overall demand really hasn't been as great on the pork side in 2023 after what was very strong years in 2021 and 2022. The piece of the puzzle here is, of course, income growth. I think consumers had a lot of income in their pockets in 2021 and 2022 that now are perhaps more constrained as they face higher interest rates, as they face higher inflation for a lot of products that may make them reduce some purchases of meat products. So I think that's one that we will have to watch as we look ahead. I always am reluctant to put this chart up, but our projections of cattle prices 2024 and 2025 suggest continued increases in fed and feeder cattle prices. Some will notice the spread continues to grow between feeder and fed prices. I think that has a lot to do with what will be the forecast of cheaper corn prices in front of us. If corn prices don't continue to move lower, perhaps feed yards aren't as excited to bid quite so hard on feeder prices as we show in these annual projections for 24 and 25. As I kind of start to wrap up, I say the headlines, and these headlines haven't changed for a period of time. Production expenses remained at the high end. I think we're going to keep farm income above long-run averages when you look at the baseline we have together. Volatility in prices continue, so we have additional grain and oilseeds, grain stocks in particular. But I think so that can add a lot of volatility to the mix. We already talked about beef, and again, I think that headwinds of inflation and general economy are important as we think about where these prices go in front of us. I appreciate the chance to visit with you all, and Brad, I'm going to turn it back over to you.
Thank you, Scott. Greatly appreciate it. I'll let you stop sharing and I'll pick up the screen here. Okay. Well, it's a pleasure to continue this discussion and bridge the national outlook into a state of Nebraska outlook. We have some questions beginning to come in on Q&A, and I'll offer a reminder to everybody. Please don't hesitate to ask questions as they come to you. We'll try and take them in a big lump after we get through some introductory material here. But please ask your questions, whether you use the chat box or preferably use the Q&A box. Please do so, and we'll get to them here. And Scott, you can read the first question there about some processing capacity and begin to formulate an answer that I'll peg you with here when we get back to Q&A. But I want to take this time to talk about the perspective nationally as it translates into Nebraska. And the first slide, just remember, we want to talk about crop and livestock production. We want to talk about what role the farm income safety net plays, even if it's a reduced role at the moment. And we want to talk about the management decisions, particularly the production costs that have factored into these issues. If we take that perspective and talk about Nebraska farm income, you'll recall that Scott put up a slide that noted that record farm income nationally in 2021 grew dramatically to a new high record in 2022 before falling back almost as dramatically in 2023 to a projected level that's on par with 2021. If you look at the Nebraska farm income numbers, it seems we took the same original point, the same final destination, but a very different path to get there. 2021 was a record farm income in Nebraska, just over $8 billion. 2023 looks like about a $7.5 billion farm income estimate in Nebraska, based on present projections and expectations. But we didn't set a record in 2022. We struggled with drought, particularly in 2022, and farm income fell to about $6.5 billion in Nebraska. We rebounded in 2023, while nationally we fell back. So we may have ended up in about the same spot. We just took a very different path to get there. 2023 looks like a rebound in spite of lingering drought concerns. If you look at crop receipts, yes, crop receipts do fall back in 2023. That's partly predominantly on lower commodity prices here in 2023 relative to 2022, in spite of recovering yield levels. The real driver for farm income in Nebraska in 2023 looks like the continued strength of the livestock sector, and particularly the receipts from the cattle industry. If you try and plug some numbers in, the cattle industry makes up about 90% of livestock receipts in Nebraska. And so as fares the cattle industry, so fares the livestock receipts in total. Now, if I look at those numbers and I try and get an assessment of where we're going, I differentiate a slide between receipts and a slide between production. This is effectively value of production that comes out of the tables that we report along with our farm income estimates. The previous slide on receipts is actual marketings during the year, cash flow during the year. The production number is adjusted for inventory valuations. And while that seems like and still looks like kind of a black box calculation from year to year, it's an important distinction because of the reality of what we lived through in 2022. Crop receipts were up in 2022, which seems counterintuitive to a big drought year, but market prices were substantially up. And so marketings of carry-in inventory at the beginning of 22 helped to strengthen receipts. Marketings during the year helped to strengthen receipts. But then we ended the year with substantially lower inventories and lower prices on those inventories. And thus the inventory adjustment was dramatic. Receipts in 22 were up. Crop value in 2022 actually fell. By comparison, 2023 looks relatively stable in value. We're talking about better yields, lower prices. Livestock receipts have grown both years. Again, that's much higher cattle prices on still shrinking inventories and marketings. So the crop numbers specifically, if you take the four biggest crops here in terms of value of production, you get a sense now of what corn has really done over the last 2 years. Acreage is up in 2023 relative to last year, but stable relative to 2021. Yields are up in 2023, but still down relative to more expected yield levels that we had back in 2021. So we've made recovery. We just haven't rebounded yet to trend expectations. And that means that production is up over year, but still down to 2 years ago. Over there of ultimately prices. Prices are dramatically lower this year than where they were last year or even the year before. That's the story in corn. It really is a very similar story in soybeans. Recovery this year in terms of yield and production, but still down relative to what our longer term expectations might have been. Now that's the crop side. If you take the livestock side and by comparison, marketings are down, inventories down, marketings are down, but prices are up dramatically, up 23% year over year on a composite beef price. That's effectively a combined composite price for cattle marketings and calf marketings, but up 23% year over year, up 44% relative back to 2021. So you really do get a sense of how dramatic those changes have been, driving receipts dramatically higher. I mentioned that the cattle market, the cattle sector represents about 90% of that farm receipts on the livestock side in Nebraska. That means that livestock looks really strong because the cattle sector looks really strong at the moment. The hogs and pigs sector have fallen back in 2023 relative to last year, relative to the longer run. The dairy sector and the poultry sector both fell back sharply in 2023 as milk prices and egg prices have come back down rather sharply. So all in all, it's really the cattle sector carrying the strength. They're carrying the water for the livestock side, and it's a rebounding crop sector that has helped to strengthen at least the receipts. Now, that's true in terms of what the crop sector has helped to stabilize, what the livestock sector has helped to carry. Of course, expenses are still a bite into that gross value, and expenses continue to look higher. The projection for 2023 is higher expenses relative to 2022. 2022 was above 21. 21 was above 20. We have been substantially ratcheting up expenses over the last several years, and we haven't seemed to top out yet. Scott shared some insight on where certain categories of expenses are going, and some categories maybe have topped or have begun to pull back, but overall expenses we're still pushing a little bit higher, and that's pressure on margin that we'll have to continue to manage. Now, there's one other part of the revenue side of this that is really the safety net side. This is commodity program payments, conservation program payments, and disaster assistance payments. What we've seen over the last couple of years is that coming off of the dramatic levels of relief or assistance offered in the midst of COVID, we have virtually eliminated the role of the commodity program support system for farm income in Nebraska. That's to say that higher prices have translated into lower or almost non-existent government payments. If you look at that chart, the commodity program payments that we typically think of in terms of ARC and PLC have all but disappeared from the chart here for 22 and 23. Conservation payments continue at around $150 million or so into the state each year. And then it's disaster assistance payments. Some of those disaster assistance payments come out of the permanently authorized standing programs, like the livestock indemnity program that pays for death losses due to weather disaster events, or the livestock forage program in particular that pays for grazing losses due to drought. Those programs continue to offer substantial help to producers as we see drought in 22 that has lingered into 23. We also see some ad hoc assistance continuing, some additional rounds of emergency relief from FSA for both crop and livestock losses that might date back a couple years, but are still being paid out and implemented here over time. So there are some dollars flowing, it looks like, from farm program payments in 22 and 23, but the role of the commodity program as a safety net has really all but disappeared here in the short run. Importantly, this does not include the crop insurance safety net. That's a federally supported safety net tool as well. It is delivered privately, and so premiums paid into the program and indemnities paid out of the program show up separately in the farm income estimates. And we can state for certain that crop insurance has been a big part of the safety net here for last year in 22 and for this year in 23. In fact, an outlook there on the crop insurance side would show that with prices lower for 2023, those producers with a revenue safety net have already effectively eaten into, or even maybe all the way through, their deductible just based on the price change from planting to harvest. That means that further losses due to yield or further losses in price would would be maybe well covered by the crop insurance safety net we have in place. So there is a safety net there. It's just a little bit different than what we typically think of in terms of looking at the commodity program first. If you summarize all that up in Nebraska, we have what we call a waterfall chart here showing you changes from year to year. And we don't just show 22 to 23 because as I noted in the very first slide, it's really difficult to explain 23 if you don't back up all the way to 21 first. 21 was a record. Relative to 21, 2022 saw crop receipts up, livestock receipts up. Production expenses were also up, which is a negative, obviously, to pull down income. And then all other changes were dramatic. That's where those inventory adjustments show up. And so crop receipts were up based on marketings during the year, but inventory adjustments were down sharply based on lower value, lower quantity and lower price inventory at the end of the year. That gave us a net farm income in 2022, as officially estimated by USDA, that came in at $6.6 billion. From that projection or that official estimate for 2022, our numbers for 2023 look like a little bit of strength. Crop receipts are down. That's recovering yield, but dramatically lower prices. Livestock receipts are still up substantially on the strength of the cattle sector. Production expenses are up even over 2022, and that pulls down income as well. And then all other changes, there's still a substantial change in everything else, particularly some further adjustments as we recover some of our ending year inventory estimates in a higher yielding production year. All of that gives us ultimately a net farm income number for 2023 that's projected around $7.8 billion. That would be near a record were it not for, well, that would be a record were it not for the 2021 number that we said earlier. So all in all, the projections say we're coping with the production challenges we've had. We're thus far coping with some lower commodity prices, but we're still looking at a very strong farm sector and a very strong farm income outlook at the present time. Now, there are some projections that we publish in the data tables that go with this farm income report. You can find those data tables on the RaFF website in conjunction with the farm income estimate. Those data tables show a projection over the next 10 years. To clarify, this isn't specifically a forecast of what will happen over the 10 years. This is a baseline of what could happen, presuming that we have sort of average changes over time in production and average changes or expected changes over time in price and changes in other sectors as well. So it's assuming no major surprises over the next decade, which we've had more than enough surprises to know that the one thing we do know is that we'll be surprised and something will happen. But this is at least a projection that says farm income is likely to return towards more long-run average levels, closer to the $6 billion range, barring substantial changes in or shocks to production and markets. That would be on the basis of crop receipts that have already moved lower here in 2023, but level out perhaps in the $13 to $14 billion range. That's slightly higher production potential each year, balanced against lower prices as we return more toward long-run average prices. Livestock receipts look strong for the next couple of years as perhaps we peak out on a price rally coinciding with the bottom of the cattle cycle. If cattle inventories rebound and production rebounds, you could expect that to level off and back up a bit on receipts. The production expenses are sort of a similar picture. They are dramatically higher over the last 4 years. There's nothing to particularly say they're going to back all the way up to where they used to be. We have perhaps ratcheted in higher production expenses that could be pretty sticky and difficult to change here over the next decade. If you break down them out just a bit more, fertilizer expenses, fuel and oil expenses, you can certainly see the peak of expenses that we've had to work through the last couple of years. If you expect those prices or those expense categories at least to fall back they may fall back, but it is other categories of expenses that still hold on here going forward. And then we think about the farm safety net as well. And if you look at the projection ahead, as I noted earlier, in 2022, we had next to no commodity program payments. 2023, the same. The look ahead says maybe commodity program payments rebound as farm commodity prices fall. Commodity program payments could rebound to the $400 to $500 million a year range. That assumes a continuation of current policies, which could happen either through an extension or a reauthorization of current programs. It does not assume any changes in policy that could happen if a new farm bill actually came to fruition. But fundamentally, we may see a rebound in some commodity program payments, but you also can't project forward very many disaster or ad hoc payments. Disaster assistance, you can expect some year in and year out based on average drought or weather losses that impact those standing programs, but you don't predict ad hoc programs. You can't really predict ad hoc programs until they arrive. And so there's relatively little support going forward, except for presumably a rebounding commodity program tied to lower commodity prices over the next decade. Those are the pictures. That's really the outlook in graphical form. I'm left with the slide here of some bullet headlines. And I realize, just like Scott mentioned, the last bullets or the last set of bullets look almost exactly like what we said 6 months ago when we released the spring estimate. And I think in my case, they are the same bullets. Crop production has rebounded. We think it's rebounded in 2023, at least based on our most recent crop estimates as of the September report. I know the October supply and demand numbers just came out an hour ago or so, but based on a September report, yeah, crop prices are lower. Recovering yields help, but receipts, marketings suffer somewhat accordingly. Livestock production pulls back in 2023 on the cattle side because of continued drops in inventory, but substantial increases in prices for cattle really drive receipts up in total. On the safety net side, the commodity program support is minimal at the moment, and it remains that. It will look a bit stronger in the next year or two, at least in terms of the level of support offered and the level of expected payments if commodity prices continue to pull back. Insurance remains the key for the moment for producers. And as I noted, insurance may be in the money already for many producers just based on the price drop from planting to harvest, let alone any sort of yield losses to go with it. Standing disaster assistance does help, and some additional ad hoc assistance is still making payments in 23, but we can't expect a long run level of elevated payments there, which means the pressure, as it always does, comes back to management. We're really managing more for margin than we are specifically trying to manage price or revenue. Higher commodity prices that have outpaced the safety net in recent years have been met with higher production costs, which means the challenge on profit margins and management decisions is just as challenging, just as difficult as it is back when we were at lower level prices, but had a safety net ready to kick in more quickly. That's the reality. That's always, frankly, going to be the reality of the outlook. There's always going to be a management challenge, a management question at whatever level of projected income or whatever level of projected prices and production we might have. So that's the challenge. I'll leave it as and move on from there. I'm going to stop so that Scott can rejoin me on camera and that we can take any questions and further the discussion here. All right. So with Scott back with us, you've gotten the picture of what we've looked at nationally and how those numbers were translated into Nebraska forecasts as well. When I showed projections over the next 10 years, that's built from the tables that support the Nebraska Farm Income Report. It's really built from the 10-year projections that are done down at Missouri at FAPRI that lend themselves over to the RaFF work on state numbers. But you've got a perspective of where we're at, and we're eager to take any questions. I am going to return to the first question that was posted there, Scott, and I'm with taking a little bit of liberty here with the participant asking a question. They were asking about the trend in hogs and the consolidation and production and processing. I would suggest or ask the bigger question: what does the trend in processing look like in general across multiple species? We've seen some pullback on hog processing and poultry processing. We are wondering about processing capacity for a cattle sector that continues to pull back on inventory. What perspective can you offer there, and what does the picture look like going ahead?
So it's a good question, Brad, and I think it does vary a little bit as we look at the different sectors. I will say we've all seen the news of Tyson and poultry plants that have been shut down. I think it's been a tough year for the poultry industry as well. I think in some cases this gives these companies an opportunity to think harder about how to become more efficient, and they're taking advantage of that opportunity. On the hog side, we've seen some news by Smithfield, both of production facilities closing, especially in northern Missouri, as well as recently the announcement of a plant closure in Charlotte, North Carolina. I'd remind us that plant closure was not a plant that was processing hogs. So we haven't lost capacity there. And for cattle, I sometimes say I'm not sure I want to be in the processing business, given how tough it is for the number side of the equation. What were incredibly strong margins for packers a couple of years ago on the cattle side, they've become extremely tight. And we're adding capacity in some cases. We have a plant coming on board here in Missouri that'll, in 2024, have a capacity of about 2,400 head a day, is what they're saying. And so I think it's going to be interesting to watch what's a very different economic outlook on the cattle processing side. To the question, I say to all of these industries, it is very hard to push production lower. Once the investments made in facilities, they tend to be difficult to go offline. And so I think in the case of pork, for example, I think we might see more consolidation happening, trying to take advantage of economies of scale. But I think it's hard to get numbers to turn down. You know, last Hogs and Pigs report gave us a 1% decline in breeding inventory. Yet pigs per litter may more than offset what we're doing in terms of lower breeding inventories. So I think production will stay fairly strong. And this is kind of the tough time right now. You're waiting for demand to catch up with what's been the supply side. But to the consolidation question, I'll say, I think if you let economics play, consolidation will continue to happen. That is not a earth-shattering statement on my part, because we've been in this mode of consolidation for a long time in many of these industries. My last little tidbit here is I might say beef cow-calf producer consolidation may be one of the things that comes out of this next building. Gone are the 40 and 50 cow beef cattle operations, and in their place are 300 to 500 head beef cow operations. So I don't think we're done with consolidation, again, if you just let economics play, because we know there are economies of scale to many of these industries.
Scott, I might take that just a bit further. As you're aware, we do some research in our CAP RaFF collaboration, and that includes the development of what we would call case farms or representative type farm operations across the state. And as we look at different regions of Nebraska, and we try and identify with a panel of producers, what does a typical operation look like? In some parts of the state, it's still very much a mixed grain and livestock operation, which means some mix of predominantly corn and soybeans plus a cow herd. And in maybe a southeastern part of the state, there's a pretty sort of common reality of 1,500 acre crop farm with about 50 cows. That's using up some available range that just doesn't really lend itself to cropping, that almost every farm seems to have. You move to other parts of the state, and the typical cow herd, if there is a cow herd, the typical cow herd is 75 to 100 to 200. It certainly varies around the state. I know Missouri varies like that too. You've got more beef cows in Missouri than almost every other state, as you showed on that graph earlier. Those acres are still out there. So are you consolidating the size of a herd, or are you just consolidating management of smaller groups?
Well, I think we've certainly had to manage more efficiently the acres that are devoted to our beef cattle operations in Missouri. We probably had excess capacity for periods of time. And when you have land values that continue to go up, all of a sudden, I think it translates into, I need to use that acre as effectively as I can, efficiently as I can. And so I think we're seeing that certainly play out. And of course, we are losing pasture land here in Missouri as well. It's amazing where we might have thought a few years ago it needed to be in pasture that can grow soybeans at $14 soybeans. Mm-hmm. So I think there's some incentive to move some pasture towards soybeans in particular that have certainly been at play here in Missouri.
I can't say that we're losing that many grazing acres here in Nebraska. We definitely have had pressure in places to put in more cropping. But there are obviously certain parts of Nebraska that are just made for cattle. And in a few cases, maybe it is the farm program again. One element of the federal farm programs that really is attractive at this point is the grasslands provision of the Conservation Reserve Program, a payment to producers, perhaps $10 to $15 an acre, a modest payment, but a payment to producers for grasslands that stay in grazing, but just work with and comply with a grazing management plan that helps protect the grassland quality, helps protect the wildlife benefits of the ecosystem as well. So we've had substantial enrollment in the first few years of the grasslands program here in Nebraska. That at least offsets a little bit of the economic pressure to move it out of grass and into something else. Scott, I wanted to take one more path down the livestock side here with you before I jump into a couple questions. It's about dairy. Dairy is not big in Nebraska, not very big, 50 some operations in the state. But our question comes from a good friend I know who is from a very important dairy state up in Wisconsin. And it's a question that fundamentally is driving the bigger dairy questions itself. Walmart as a dairy processor, what does that mean? Walmart already has some substantial relationships with some existing dairy capacity in other parts of the country. What does that mean in general when you've got sort of a shakeup in the traditional dairy processing space? And what does that mean for the industry as a whole?
Yeah, so it's a really good question to grapple with. I find it interesting where this question comes at the same time that we have USDA trying to revamp federal milk market orders as well, or at least have the hearing about where we go with federal milk marketing orders. I think we're trying to be in a situation where the Walmarts of the world feel like they're economies of scale they can capture by going vertically in terms of what they're doing. Does it create new challenges for the dairy industry? Absolutely. I think it creates additional challenges. The old system. I guess I go back to generalize a little bit about what's going on, because to me this is all about how we get meat and dairy products from the farm to the store, and how do we price them at each point along the way. Getting a farm value, I think, gets harder and harder. In the case of cattle and hogs, we talk about very thin markets. We don't have that in dairy because we have the federal order sitting there trying to help us create minimum prices for the different classes of milk. All of those have their challenges in terms of how well they work at times.
Mm-hmm.
And when you add the Walmarts of the world saying, hey, I'm going to go get in the processing part of the game, then I think it opens up questions about which farmers get to take advantage of maybe some higher class 1 prices. And does it continue to make federal orders work like they have in the past, where short of depooling, you hope that producers are getting roughly the same blend price back? It just continues to challenge the structures that we've had in place in the past from a pricing standpoint.
Scott, that sounds like the lead off to another webinar topic in its own right, would be the future of dairy policy, which may or may not depend on the fate of a farm bill, but between the dairy support program and the margin program that's contained in the commodity title of the dairy bill, of the farm bill, as well as the whole federal milk marketing order system and the pricing system, is a real political or real policy puzzle here to solve yet. So I want to answer a couple more questions here in our limited time left. The crop and livestock insurance products I mentioned are an important part of the safety net. It's worth noting that, yes, those are privately delivered, but there are federal crop and livestock insurance products. There's federal support for those. There is a premium subsidy or effectively a federal cost share on the producer premium that is due. There is a federal support for the insurance companies that deliver those products. And then there is a federal support in terms of a reinsurance pool, or a pool where the companies can share their risk of the policies they've written. All three of those types of support help reduce the delivery cost and increase the attractiveness of those products to producers. Crop insurance, we know, is widely adopted and has tremendous market share in terms of the federal multi-peril crop insurance tools. Yield protection, revenue protection without the harvest price. Those three main tools, for example, widely adopted in our main commodities. On the livestock side, we have seen increased development really over the last 20 years, but dramatically increased participation over the last few in products that are effectively price risk management products. Livestock risk protection is a price risk management tool. You buy it from the insurance agent, but it effectively looks like a marketing hedging type tool. Livestock gross margin is a price minus feed cost or price minus feeder type calculation. And then there is dairy risk management, which is a milk price minus feed cost policy. So there are price or margin-based risk management tools on the livestock side that have grown substantially over time. Those I consider part of the federal safety net, even though they are producer purchased and privately delivered because of the federal support they have. That's not counting the private products like wind and hail coverage, for example, that might be sold on a crop policy. Those are privately developed, privately priced and delivered products, and privately serviced as well. Maybe the same agent selling you a federal product with a private add-on tool available, but that's the private side of the insurance sector. Those all have provided substantial support. The estimate of both the federal and the private side show up in the farm income estimates. The cost of the federal support shows up as a farm bill item and discussion item, but fundamentally in the income estimates, we're talking about and showing sort of the combined federal supported and privately supported and delivered products. So that's the perspective of where we are in the insurance products at the moment. The last question, Scott, I'll throw it back to you, and we'll maybe both take a quick stab at it. But it fundamentally relates to cover crops. If the livestock sector, and specifically the cattle sector, is competing with crop returns for grazing acres, and here in Nebraska, as I noted, the certain areas we know stay grazing, but certain areas we're definitely competing. What's the role of cover crops in maybe adding to that grazing capacity, or at least reducing the competition for acres? We have cover crop adoption. It's grown dramatically. The amount of cover crops that we have in Nebraska that are specifically grown for purposes of grazing may be relatively small, but they certainly are adding to capacity. Missouri may be a more prime opportunity or a more prime location for some cover cropping. What's the picture look like, and what does it mean going forward?
Yeah, so number one, you were talking about insurance. I wanted to remind folks, especially in Nebraska, you all, I think, have the opportunity for the weaned calf risk protection program.
Thank you. Yeah.
In 2024, that is a new one for folks to look at. I'll leave that set aside, but Nebraska.
Which to clarify, thank you for mentioning that dropped in my mind as I was listing them out. That's the first livestock product that would actually cover both a price and production component. We do have whole farm revenue protection, which theoretically offers that opportunity, but has had limited uptake. The wean calf policy is Nebraska is one of the pilot states, and you're right, that'll be the first test of whether that kind of policy works for us.
And I think it's important. We're not going to hear about this nationally because there's only a few states where this is going to pilot in 2024, but there may be some opportunities to use that as a cow-calf producer that traditionally we might have used LGM or LRP. Mm-hmm. To the question though about cover crops, to me the easy answer is yes. I think it helps from a cattle perspective. Exactly to what extent, I think, is the unknown piece of that question to really address. I think in periods of short hay supplies, this is where cover crops can come in and fill the gap a little bit better than what we've traditionally had. I think in some cases, if you're going to try to graze those cover crops, unfortunately, we tend to lose fences, we tend to lose water, and so it's not always as easy as we'd like it to be to go graze some of those cover crops in periods of time. But I do think it provides a little bit more of a shock absorber. We'll see where cover crops goes the next 3 to 5 years. To me, that's most important, of total acres available, and how that could potentially offset other periods of time when we're short on grass.
Yeah. Well, thank you for that, Scott. I appreciate the time you've given to us, and appreciate the insight that on these big issues for Nebraska, for the U.S. as a whole, but big questions on where we're heading with the farm sector and the economic outlook. I thank everybody that has joined us. Many of you are still on here as we close a little bit after the hour, but I thank you for joining us, and I hope this is useful and valuable to you. Some information in here to help your planning and decision making for the coming years. I look forward to the time about 6 months from now that we'll probably be back on the webinar again to talk about the spring outlook, which will include a first go round at a 2024 state level farm income projection. But I thank you, as I said, for joining us today and getting the current perspective. Remember, this webinar, like all of our CAP webinars, are recorded and posted, so there is an archive available to you on our website at cap.unl.edu. In the same place, you can find a list of our upcoming webinars and participate and sign up for those that look of value and of interest to you. So please consider doing so. as you leave, we would also appreciate your feedback. So I believe when you exit the Zoom menu, you'll get a brief pop-up asking you a question or two. We appreciate that input to help us understand the value of what we did today, as well as the ideas for what we could do in the coming weeks. So with that, thank you for joining us. I appreciate the time you've given us. Thank you specifically to Scott and to Taylor Ann Washburn, who's with us as well, but hiding behind the scenes, Ryan Evans as well here in the CAP Center, hiding behind the scenes, but they're the people that really make both of us capable of doing this today. So we appreciate their input and value contribution here. So with that, finally, thank you for the day. We wish you well and look forward to seeing you the next time.